Welcome to the Deep Dive. Today we're looking into TACC stock, TAC Consumer Public Company Limited. TACC shows promising signs, with new product development and customer base expansion. Hello and welcome to Insight AI Brief Set Tie. Today we're discussing TACC stock. Before we begin, please don't forget to like, share, and subscribe. Our mission, as always, is to unpack the latest performance, their strategic plans, and what the future might hold using the information we've gathered.
And TACC is definitely an interesting one. It's got this unique position, heavily tied to a key partner, but also trying hard to diversify. We'll dig into some interesting nuggets here. And actually, one thing that jumps out right away is their dividend. It's pretty attractive, quite stable payouts too. They often pay out more than their minimum policy suggests, which, it points to some real underlying financial strength. Management seems confident.
That is interesting. A strong dividend is always eye-catching. Okay, let's unpack this TCC story then. How are they actually managing this growth and prepping for what's next? So let's dive into the latest numbers. We're looking mainly at Q2 of 2568, that's 2025 for most of our listeners, and the first half overall. For Q2, sales revenue was 577.68 million baht. That's up a solid 16.07% from last year. Pretty good jump.
Yeah, that's quite healthy growth.
And the net profit. 79.05 million baht, also up strongly, 15.66% year over year. Impressive numbers for just one quarter, wouldn't you say?
Absolutely. And if you look at the whole first half of 2568, the picture holds up, maybe even better. Total sales hit 11,107.66 million baht, up nearly 16%, 15.91% to be exact.
Okay.
But the net profit, that surged even more, up 18.2%, hitting 152.16 million baht. And, this kind of double-digit growth, it doesn't look like just a lucky break. It's just they're executing well, their model's resilient even in a tough market.
Right. Consistent double digits. So what's fueling this? What are the drivers here? Our sources point to a few things. First, new products, especially working closely with 7-Eleven. They keep calling them their key strategic partner.
That relationship is central.
Then there's the general recovery in spending here. Plus, seasonal demand for drinks. Hot weather helps, I guess.
Definitely.
And classics like Thai tea, green tea, they just stay popular. Plus, they seem to be widening their customer base, both B2B and B2C.
That's all true. But there's a really important detail behind those headline numbers, a bit of a nuance. Despite that strong revenue, TTC got hit by rising raw material costs. Coffee beans, especially, got more expensive. And that actually pushed their gross profit margin down by about 1.31 percentage points, or 131 basis points. That's a noticeable squeeze on profitability before overheads.
Right, 131 basis points is significant. So if raw material costs went up and squeezed the gross margin, how did they still manage to grow the net profit so well? That seems counterintuitive.
Yeah, it does raise that question, doesn't it? How did they absorb that pressure? And the answer is really effective cost management internally. They were really good at controlling their SG&A, selling, general, and administrative expenses. Think marketing, salaries, office costs, all that stuff.
It's the operational costs.
Exactly. By keeping a tight lid on those, they basically cushioned the blow from the lower gross margin. It didn't hit the bottom line nearly as hard. So their internal cost discipline, absolutely key to keeping that net profit growing. It shows real management skill.
That kind of discipline is definitely good to see. Okay, let's shift a bit. What about their overall financial health? Growth is great, but is the foundation solid?
Oh, definitely. And connecting this back, their balance sheet looks remarkably strong, really robust. They have a very low debt-to-equity ratio, only 0.68 times. That's incredibly low.
Yeah.
It means they're not heavily reliant on borrowing. Lots of flexibility there.
Like owning your house almost outright, you mean?
Pretty much, yeah. And their current ratio is high, 2.28 times. That signals strong liquidity, plenty of short-term assets to cover immediate bills. So this kind of financial muscle, it gives them a solid base for future investments, for M&A, and just for weathering any market storms. It's vital for the kind of diversification they're planning.
That makes perfect sense. You need that strong base for ambitious plans. So let's look at those plans. What's the vision for 2025? They've set a pretty bold revenue target, haven't they? Aiming for at least 10% growth. That would push total revenue over the 2,000 million baht mark. That's a big number.
It is a significant target. And their strategy to get there, they call it compounding quality value. It sounds a bit like corporate speak, maybe, but the idea is sustainable growth, focusing on long-term value, not just short-term gains. It means constantly tweaking costs, both direct and indirect, making sure they grow efficiently as they scale up. growing smart, essentially.
Okay, growing smart. Let's break down the segments. The B2B side, mainly 7-Eleven. What are the plans there? Are they just keeping things ticking over?
Oh no, far from it. It's quite dynamic. They're constantly working on the menu, both the core stuff, the reliable sellers, and bringing in new things, like new jet spray drinks under the 7 Select brand. More non-coffee options for all cafe, catering to different tastes.
Right.
And interestingly, they're expanding internationally with 7-Eleven too. Cambodia, Laos, developing specific drinks for those local markets. It really shows how deep that partnership is. They're not just a supplier, they're co-developing.
That 7-Eleven link is obviously huge for them, but like you said, maybe too huge in the past. Sources mentioned it was over 90% of their revenue at one point. That feels like a risk.
It absolutely is. That's the classic concentration risk. Provides stability, sure, but also vulnerability. So TACC's long-term strategy is very clear on this. Reduce that dependency. They're aiming for B2B, mostly 7-Eleven, to be around 70% of revenue.
Okay.
And deliberately grow the B2C side, the non-7-Eleven business, to make up the other 30%. The major strategic pivot. Diversification is the name of the game.
Right, building new legs for the business to stand on. Which leads us nicely to that B2C diversification. Where exactly are they focusing their efforts there? This seems like where the new action is.
It really is. It's a multi-pronged approach. They're developing products for the wider cafe business segment, trying to get beyond just the 7-Eleven locations. They're pushing hard on acquiring new customers, both here and abroad. And a big piece is building their own brands.
Their own identity.
Exactly. Especially in health and wellness. That's a booming sector. The acquisition of Bloss Nature fits right into that, tapping into that demand for healthier choices.
Makes sense.
Plus, they're working on expanding sales channels and boosting awareness for their character businesses. Licensed characters on products. Appeals to a whole different market segment.
That's a lot of moving parts. And I see they're also explicitly looking for new S-curves, using M&A, joint ventures. Can you unpack that S-curve idea a bit? Why is that language important here?
Sure. Think of a product's life cycle like the letter S. Slow start, then rapid growth, then it levels off, matures. When a company like TCC talks about finding new S-curves, they mean they're looking for new businesses or ventures through buying companies or partnering up that can kick off a whole new phase of rapid growth for them.
Okay. Adding new growth engines to the portfolio.
Precisely. It's about ensuring long-term vitality, not just riding the current wave. And alongside this search for new growth, they're also bringing in tech for efficiency and focusing on ESG, environmental, social, governance, making sure growth is sustainable, responsible. Investors care more and more about that now.
So, putting it all together, lots of positive signs for the second half of the year, this big strategic shift. But you mentioned risks earlier. What's the main challenge you see in this ambitious plan?
Right. The diversification strategy makes sense. It's necessary even. But the challenge is the B2C market itself, especially health and wellness. It's incredibly crowded, super competitive. Success really depends on TCC's ability to adapt, innovate fast, and actually generate significant revenue from these new areas.
It's not enough just to launch products, they need traction.
Exactly. They need enough revenue to genuinely offset the risk concentration they still have with 7-Eleven, even if it drops to 70%.
Yeah.
It's a totally different game than B2B. Different marketing, different distribution. How well they execute this B2C push, that's the real test.
A crucial point indeed. Okay, let's pivot to the analysts and shareholder returns. Our sources suggest an analyst target price around 6.12 baht. The stock's currently trading at 4.88 baht. So analysts see some potential upside there.
Yeah, about a 25% upside based on that target. And what really backs up the positive view, or at least shareholder value, is the dividend we touched on earlier. The board just approved an interim dividend of 0.21 baht per share. That's a total payout of 126 million baht. Record date is August 25th, 2568. Payment on September 5th. It's a tangible return to shareholders, and like I said, signals confidence.
And is this regular? We talked about stability. How reliable is this dividend payout pattern for TCC?
Oh, very reliable. They have a consistent history. They pay out twice a year, almost like clockwork. And notably, the total payout often exceeds their official minimum policy.
Really? They pay more than they promise.
Often, yes. For instance, the dividend yield for Q2 2568 was a healthy 4.39%. This consistency isn't just luck. It reflects management's belief in their strong cash flow and solid balance sheet. It shows they can fund growth and reward shareholders reliably. That's a strong message.
Definitely a plus for income investors. Okay, just briefly on the stock's recent movement, give us some context. The 52-week range was between 3.94 and 5.30.
Right. And as you said, the current price is 4.88 baht. So it's trading comfortably within that range, sort of in the upper middle part of it. It gives you a feel for where it sits historically, right? Not pushing new highs or lows right now, based on the data we have. Suggest some consolidation, perhaps.
Okay, good context. So let's wrap up this deep dive on TACCs. We've seen a company with solid financials, impressive growth recently, even with some cost pressures. They've got clear, ambitious plans, optimizing the core B2B with 7-Eleven while making a big strategic push into B2C diversification, all supported by a strong balance sheet and that attractive, stable dividend.
That sums it up well. TACC definitely has a strong base with 7-Eleven, no doubt, and that dividend history is compelling for many investors. However, the big question mark, the crucial unknown, is the success of that B2C ambition, especially in that crowded health and wellness space. Can they really build those new S-curves? Can they pivot effectively, innovate, generate enough new revenue to truly diversify, and do it all while keeping costs tight and maintaining overall profitability? That's the execution challenge. That's what will really determine their long-term value and growth story.
It's a really interesting strategic challenge to watch. We hope this deep dive has given you, our listener, plenty to think about regarding TACC's journey. Finally, if you have any other stocks you'd like us to cover, please let us know. Don't forget to like, share, and subscribe to support our team. Thank you. Until next time, keep exploring.